Stop what you're doing right now. If you own silver, if you've been watching the silver market, if you've been thinking about adding to your stack, I need you to lock in for the next 25 minutes, because what I'm about to show you is the clearest signal we've had in years that the physical silver market is fundamentally breaking. And I'm not being dramatic here. I'm talking about something that hasn't happened at this scale since the 70s. And most people stacking silver right now have absolutely no idea what these premium numbers are actually telling us. Something critical happened over the last few weeks that changed everything, and the data I'm seeing from dealers, from mints, from refineries is making my hands shake as I record this. We're watching premiums on physical silver that have gone from what we'd consider normal, 2 to 3% over spot, to sustained levels of 15% and higher. And here's what you need to understand. This isn't a temporary spike. This isn't some weekend rush that clears up by Monday. We've been running at these premium levels for months now, and they're not coming down. They're expanding. I just got off the phone with 3 different dealers yesterday, and what they told me about their inventory situation, about delivery times from refineries, about what's happening behind the scenes at the wholesale level, it confirms everything I've been tracking in the data. We are watching a physical supply crisis unfold in real time. Here's what we're going to cover today. And I need you to stay with me through all of this, because each piece builds into a picture that most people in the silver market are completely missing. First, I'm going to walk you through exactly what these 15% premiums mean. Not the surface level explanation that premiums go up when demand is high, but what's actually happening in the physical supply chain that creates this kind of sustained premium elevation. We're going to look at the mechanics of how silver gets from mine to refinery to dealer to you, and where the breakdown is occurring right now. Second, I'm going to show you the data that proves this isn't temporary. We're going to compare current premium levels to historical data going back to 2019, and you're going to see a pattern that should make every silver stacker pay very close attention. And third, I'm going to give you my framework for what to do about this right now. Whether you're already stacked, whether you're just starting, whether you're sitting on the sidelines waiting for spot price to drop, I'm going to show you why these premiums are actually the story, not the spot price, and how to position yourself correctly in a market where physical availability is becoming the limiting factor. Now, here's why you need to hear all of this. The mainstream precious metals commentary is focused on spot price. You see videos talking about whether silver is going to 35 or back to 28, whether the technical breakout is confirmed, what the charts are saying, and that's all fine, but they're missing the structural story. They're not talking about the divergence between paper silver trading on the COMEX at spot price and physical silver that you can actually hold in your hand trading at 15% over that spot. They're not connecting the dots between refinery capacity constraints, mint rationing, dealer inventory levels, and what this means for the 6-month, 12-month outlook. But before I get to that, you need to understand what happened the last time we saw this pattern, because history doesn't repeat, but it absolutely rhymes. And right now we're hearing a very familiar melody that anyone who was stacking in 2020 and 2021 should recognize immediately. Let me take you back to March 2020. The world shuts down for COVID, markets panic, and something interesting happens in the silver market. Spot price actually drops initially. Silver falls from around $18 down to $12 in the span of a few weeks. And if you were watching spot price, you might have thought, great opportunity, silver just went on sale, I'm going to load up. But here's what actually happened. You couldn't buy physical silver at $12. You couldn't buy it at $15. By the time you could actually find inventory at dealers, you were paying $18, $20, $22 for silver that was supposedly trading at $12 spot. The premiums exploded to 50%, 70%, even higher on certain products. Why? Because the physical market and the paper market completely disconnected. The COMEX was trading silver contracts at $12, but nobody could actually deliver physical metal at that price because refineries were shut down, transportation was disrupted, and retail demand was going absolutely nuclear while supply chains were frozen. Now fast forward to today, and we're seeing the same pattern develop, but this time it's not because of a pandemic shutdown. This time it's structural. It's supply deficit meeting industrial demand, meeting investment demand in an environment where refining capacity hasn't kept pace and mining production is essentially flat. Let me show you exactly what I'm seeing in the data right now, and I'm going to give you specific numbers because vague warnings don't help anybody. Silver spot price, as I'm recording this, is sitting around $32 per ounce. That's the paper price, the COMEX price, the price you see quoted on financial websites. But if you actually want to buy physical silver right now, here's what you're paying. Silver American Eagles, the most popular coin, you're paying between $36 and $38, depending on the dealer and quantity. That's a premium of 12.5% to 18% over spot. Silver rounds from private mints, generic 1-ounce rounds, you're paying $35 to $37. That's premiums of 9 to 15%. Even if you buy in bulk, Even if you buy monster boxes of 500 ounces, you're still paying premiums that are triple what we'd consider normal in a healthy market. Now let me put that in context. Go back and look at premium data from 2019, before COVID, before the 2020 rush, when the silver market was functioning normally. Average premiums on silver rounds were $1 to $1.50 over spot. On a $20 spot price, that's 5 to 7.5%. On American Eagles, you'd pay maybe $2 to $3 over spot. So 10 to 15% premiums were normal on government coins, but you could always get generic rounds cheap. That was the market. If you wanted to pay up for Eagles because you liked the design or the government backing or the liquidity, fine, you paid the premium. But if you just wanted ounces as cheap as possible, you could get within $1 or $2 of spot. That option doesn't exist anymore. The cheap generic silver is gone. What used to cost $1 over spot now costs $4 to $5 over spot, and it's been that way for over a year. This is a sustained structural shift, not a temporary spike. Here's what's actually happening behind the scenes, and this is where most people lose the thread because they don't understand the physical silver supply chain. Silver doesn't go straight from mine to your hand. It goes through multiple steps, and at each step right now, there are constraints. Step 1, mining production. Silver comes out of the ground either as a primary product from silver mines or as a byproduct from copper, lead, and zinc mines. About 70% of silver production is actually byproduct, which means the supply is partly determined by demand for other metals. Global silver mine production has been essentially flat for the last 5 years. We're producing around 850 million ounces per year, and that number isn't growing because there aren't enough new high-grade silver deposits being developed, and existing mines are seeing declining grades. So supply from mining is basically fixed. Step 2, refining. The silver that comes out of mines is not in a form you can make coins or bars from. It needs to be refined to 999 fine silver. There are only a limited number of refineries in the world that can do this at scale, and they operate at close to capacity during normal times. When demand surges, they can't just magically double production. They're running 24/7, they're prioritizing their contracts, and lead times extend. Right now, I'm hearing from sources that refinery lead times for new orders are running 8 to 12 weeks, when normal times would be 4 to 6 weeks. That's a doubling of the time to turn raw silver into deliverable product. Step 3, fabrication into products. Once you have refined silver, it needs to be minted into coins or cast into bars. The US Mint, the Royal Canadian Mint, the Perth Mint, private mints like Sunshine, Scottsdale, these facilities also have capacity constraints. The US Mint has actually been rationing Silver Eagles to dealers for months. They're not producing enough to meet demand, so dealers get allocated a certain amount, and that's it. When the mint itself is rationing the most popular silver coin in the world, that tells you something fundamental about the supply-demand balance. Step 4, distribution to dealers. Once product is manufactured, it goes to wholesale distributors and then to retail dealers. Dealers used to carry deep inventories because they could replenish quickly, and because storage costs money, so you don't want to sit on too much. But now dealers are keeping inventory as low as possible because premiums keep rising and they don't want to be stuck with metal they bought at lower premiums while the market is moving up. What this means practically is that when you go to buy, dealers are buying from wholesalers or direct from mints at high premiums, and they're passing that through to you plus their margin. There's no inventory buffer anymore. Everything is just in time, and when demand spikes even slightly, product disappears within hours. I've seen major dealers go from showing 500 monster boxes available to 0 available in a single day, and then it takes weeks to restock. This is not normal market functioning. This is a market under stress. Now let's talk about demand, because supply constraints only matter if demand is strong, and right now demand is coming from multiple directions simultaneously. First, investment demand from retail stackers like you and me. People are losing faith in fiat currency. They see inflation eating their purchasing power. They want hard assets. Silver is more accessible than gold because of the lower price per ounce, so you get broad-based retail demand. Second, industrial demand. Silver is used in solar panels, in electronics, in EVs, in 5G infrastructure. These aren't optional luxury uses. These are critical applications that require silver because there's no substitute with the same electrical and thermal conductivity. Industrial demand for silver is running about 500 million ounces per year and growing as electrification and green energy build-outs accelerate. Third, jewelry and silverware demand, which is smaller but still significant, around 200 million ounces annually. Add those up. 850 million ounces of supply, 500 million industrial, 200 million jewelry, and then investment demand on top. We've been running a supply deficit for years, meaning demand exceeds newly mined supply, and the gap is being filled by above-ground stocks, recycling, and drawdowns from inventories. Here's where it gets interesting. The COMEX, the commodities exchange where silver futures are traded, maintains warehouses where physical silver is stored. There are two categories: registered inventory, which is silver that's available to be delivered against futures contracts, and eligible inventory, which is silver being stored but not currently available for delivery. Over the past 2 years, we've seen registered inventory decline significantly while eligible inventory has grown. What that tells us is that people are storing silver in COMEX warehouses, but they're not making it available for delivery. They're holding it. And when you have less registered inventory available for delivery, but the same or higher levels of paper trading, you're setting up a scenario where the paper market and the physical market can disconnect violently. We saw this in 2020, and we're seeing the early stages of it again right now with these sustained high premiums. Let me give you the numbers. COMEX registered silver inventory right now is sitting around 80 million ounces. Sounds like a lot. But daily trading volume on COMEX silver futures can be 200 million ounces or more. Think about that ratio. The entire deliverable supply in COMEX warehouses is less than half of one day's paper trading volume. Now, most of those contracts are never intended for delivery. They're just financial speculation, but if even a small percentage of contract holders demand physical delivery, the system breaks. And that's exactly what these premiums are telling us. The market is pricing in a premium for the certainty of physical metal in hand because there's growing doubt about whether you can reliably convert paper silver into physical silver at spot price. That premium is the market's way of saying physical is scarce, and if you want it, you're going to pay up. Now, here's the part that most people stacking silver don't fully appreciate. When you buy silver at a 15% premium today, you might look at that and think, wow, I'm overpaying, I'm getting ripped off. I should wait until premiums come down. But what if premiums don't come down? What if 15% becomes the new normal and then it goes to 20%, then 25% because the supply situation gets worse, not better? In that scenario, buying at 15% premium today isn't overpaying. It's actually getting in before the premium runs away from you entirely. This is the psychological shift that silver stackers need to make. You're not buying silver to trade it based on spot price movements. You're buying silver as insurance, as a store of value, as protection against currency debasement. And in that context, the premium you pay today is irrelevant if the alternative is not having any physical metal at all when you need it. Let me walk you through what I'm actually seeing from dealers on the ground right now, because this is where the rubber meets the road. I have relationships with several large online dealers and a couple of local coin shops, and I talk to these guys regularly to get a sense of what's happening with supply. Here's what they're telling me. Number one, restocking times have doubled or tripled. Products that used to come back in stock within a week are now taking 3 to 4 weeks. When they order from wholesalers or direct from mints, lead times are significantly extended. Number two, allocation is happening. The U.S. Mint is only producing a certain number of Silver Eagles, and dealers are getting allocated based on their size and order history. Smaller dealers are getting squeezed out entirely, and even large dealers are getting fewer coins than they want. This creates artificial scarcity at the retail level, even when the mint is theoretically still producing. Number three, premiums are being adjusted in real time. Dealers used to set premiums once a day or even once a week. Now premiums are changing multiple times per day based on inventory levels and wholesale costs. When a dealer gets a shipment in, the premium might be 12%. 6 hours later, after that shipment sells, the premium is 15% because the next shipment from the wholesaler costs more. This is not a stable market. This is a market where the price of physical is being discovered in real time based on actual scarcity. Number four, and this is critical, dealers are telling me that the bid-ask spread has widened significantly. When you sell silver back to a dealer, they're not buying it at the same premium you paid. You might buy it 15% over spot, but when you sell, they're offering you spot or maybe 2% over. That spread is wider than it's ever been, which tells you that dealers are uncertain about being able to move inventory, and they're protecting themselves with wider margins. For stackers, this means you need to think in longer time horizons. If you're buying silver to flip it in 3 months, you're going to get destroyed by the spread. But if you're buying to hold for 3 years, 5 years, 10 years, the spread doesn't matter because you're not planning to sell back into fiat currency anyway. And number five, product mix has changed. The generic cheap stuff is gone. What's available now is mostly government coins, which carry higher premiums, or larger bars, like 10-ounce and 100-ounce bars, where the premium per ounce is lower, but you're committing more capital. The 1-ounce rounds and 10-ounce bars that used to be the bread and butter of affordable silver stacking, Those are the hardest to find and carry the highest premiums relative to their historical norms. So what does all of this mean for you as someone who either owns silver or is thinking about buying silver? Let me give you the framework I'm using to think about this, and then I'll give you specific tactical steps based on where you are in your stacking journey. The first principle you need to understand is that we are transitioning from a market where spot price was the story to a market where physical availability is the story. For decades, you could buy silver at a small premium over spot anytime you wanted. Spot price went up, you could buy. Spot price went down, you could buy. The premium was a minor friction, and your decision was based purely on whether you thought spot price was going higher or lower. That world is over. We're now in a world where the premium is telling you something independent of spot price. It's telling you about the physical supply-demand balance, and right now it's screaming that physical is tight. Second principle, premiums are sticky on the upside and slow to come down. When premiums spike due to a demand surge, they don't immediately crash back to normal when demand eases. They tend to establish a new higher baseline. We saw this after 2020. Premiums spiked to 50% during the panic. They came back down, but they settled at a new normal of 8 to 10% on rounds, not the 2 to 3% we had before. Now we're at 15%, and even if there's a temporary demand lull, I don't expect premiums to go back to 8%. The new baseline is probably 12 to 15%, and it could go higher. What this means practically is that if you're waiting for premiums to collapse back to 2019 levels before you buy, you're probably going to be waiting forever, and you'll miss the opportunity to stack at current levels. Third principle, dollar cost averaging beats timing in a premium expansion environment. If premiums are rising over time and supply is getting tighter, trying to wait for the perfect entry is a losing strategy. You might wait for spot price to drop from 32 to 30, but in that time premiums go from 15% to 18%, and you end up paying the same or more. Better strategy is to set a budget, buy a fixed dollar amount every month or every quarter, and accumulate consistently regardless of spot price or premium fluctuations. Over a 12-month period, you'll average in at a reasonable cost, and you'll be building your stack while metal is still available. The worst scenario is waiting for perfect conditions, watching premiums run away, and then panic buying at 25% premiums when supply gets even tighter. Fourth principle, product selection matters more now. When premiums are low, it doesn't really matter what you buy because everything is close to spot. But when premiums are high and varied, you need to be strategic. Government coins like Eagles and Maples carry the highest premiums, but also have the best liquidity and recognition when you go to sell. Generic rounds carry lower premiums but may be harder to sell, and you'll get less back. Large bars, 10 ounce, 100 ounce, kilo bars have the lowest premium per ounce because you're buying in bulk, but they're less divisible and require more upfront capital. My recommendation for most stackers is a barbell approach. Core position in low premium products like 10 ounce bars or kilo bars where you get the most ounces for your dollar, then a smaller allocation to high premium government coins for liquidity and recognizability. This gives you both the bulk ounces you want for wealth preservation and the liquid coins you can sell easily if you need to. Fifth principle, storage is now part of the equation. When premiums are 15% and you're paying significantly over spot, you need to protect that investment properly. Leaving silver in a drawer or a closet where it could be stolen is not acceptable when you're paying these prices. You need a real storage solution. Home safe bolted to the floor, safety deposit box at a bank, allocated storage with a professional vault, or a combination. The cost of proper storage is minor compared to the risk of loss, and when you're paying 15% premiums, you're making a serious investment that deserves serious protection. I personally use a 3-location strategy, some at home in a safe, some in a bank box, some in allocated storage at a private vault. That way, if any single location is compromised, I don't lose everything. Now let me give you specific action steps based on where you are. If you're new to silver and you're just starting to stack, here's what I'd do. Start with a small position to get exposure and learn the market. Don't go all in on your first purchase because you need to understand how premiums work, how different dealers operate, what products you prefer. Buy maybe 5 to 10 ounces to start, pay the premium, take delivery, hold it in your hand, understand what you're buying, then set up a dollar cost averaging plan. Decide on an amount you can afford every month, maybe $100, maybe $500, whatever fits your budget, and commit to buying that amount monthly for at least 6 months. This removes emotion from the equation and builds your stack consistently. Focus on low premium products for your core accumulation. 10 ounce bars, kilo bars, generic rounds in quantity. You're trying to get the most ounces for your dollar. Don't worry about collecting every different design or mint. You're stacking weight, not numismatics. If you're already stacking and you have a position, here's what I'd think about. First, assess your allocation. What percentage of your net worth is in silver? If it's less than 5% and you believe the thesis about currency debasement and supply shortages, consider adding. If it's already 10, 15, 20%, you might be adequately positioned and you're just maintaining. Second, look at your product mix. Do you have enough low premium bulk ounces, or did you overpay for fancy coins? If you're heavy on high premium products, consider balancing with some bulk purchases. If you're all generic, consider adding some government coins for liquidity. Third, check your storage situation. Is your silver properly secured? If not, fix that now while you're thinking about it. Fourth, consider the opportunity cost of waiting. If you believe premiums are going higher and availability is getting tighter, adding to your position at 15% premiums today might be better than waiting and paying 20% premiums in 6 months. I'm not saying go all in, but if you were planning to add anyway, these premium levels are a signal to act rather than wait. If you're watching from the sidelines and you've been thinking about silver but you haven't bought any, let me be direct. These premium levels are not a reason to avoid silver, they're a reason to pay attention to silver. The market is telling you something. It's telling you that physical metal is becoming scarce relative to demand, and that scarcity is being priced in. You can wait and hope premiums come down, but what if they don't? What if we're at the beginning of a multi-year period where physical silver premiums stay elevated or go higher because the structural supply deficit continues and industrial demand keeps growing? In that scenario, the person who bought at 15% premiums in 2025 is going to look smart compared to the person who waited and paid 25% premiums in 2026 or couldn't find any at all. I'm not trying to create false urgency, but I am trying to help you understand what the data is saying. 15% premiums are not normal. They're a signal, and if you believe in owning physical silver as part of a diversified strategy for wealth preservation, now is not the time to be paralyzed by premium anxiety. Let me address the objections I know some of you are thinking. Objection 1. What if spot price drops and I'm stuck with metal I bought at high premiums? Here's the thing. If spot drops from 32 to 28, and you bought at 15% premium, yes, your cost basis is 37, and spot is now 28, so on paper, you're down. But the premium probably doesn't compress in that scenario. In fact, if spot drops and retail demand surges because people see it as a buying opportunity, premiums might actually expand. So you might see spot at 28 but premiums at 20%, which means you're still paying 33 to 34 to buy. And if you already own at 37, you're actually not that far off. More importantly, if you're buying silver for the long term, a temporary spot price drop is irrelevant. You're not trading this. You're holding through volatility because you believe the long-term trajectory is higher as currency debasement continues. Objection 2. What if premiums collapse back to normal and I overpaid? Could happen. If industrial demand drops due to a recession, if investment demand dries up, if supply increases significantly, premiums could compress. But based on everything I'm seeing in the structural supply situation, that seems unlikely in the near to medium term. Mining production isn't increasing. Refining capacity isn't expanding. Industrial demand is growing, not shrinking. The risk of premiums collapsing back to 3% seems much lower than the risk of premiums expanding to 20% or supply becoming truly scarce. I'd rather be positioned and potentially pay a few percentage points more than I needed to than be on the sidelines watching premiums run away and not having any metal. Objection 3. Isn't this just dealers gouging customers? Are premiums actually justified, or is this just greed? Look, dealers are businesses and they charge what the market will bear. But the premium isn't arbitrary. It's a function of their wholesale cost, their margins, and supply-demand dynamics. When I talk to dealers, they're not making massively higher margins on a percentage basis. They're paying higher wholesale prices, and they're passing that through. The refinery is charging more because their costs are up and their capacity is constrained. The mint is rationing supply. These are real supply-side constraints creating real scarcity, and the premium is the market's way of allocating that scarce supply. If premiums were unjustified, we'd see inventory piling up on dealer shelves because nobody would buy at those prices. Instead, we're seeing inventory move quickly and restock times extending. That tells me the premiums are market-clearing prices, not artificial gouging. Here's what I'm doing personally, and this is not financial advice, just transparency about my own approach. I've been stacking silver since 2012, so I have a core position that I accumulated mostly at low premiums. I'm not chasing ounces at any price, but I am continuing to add methodically. I'm buying about once a quarter, focusing on 10-ounce bars and kilo bars because those have the lowest premiums per ounce right now. I'm paying the 15% premium, and I'm not losing sleep over it because I view this as a long-term hold, minimum 5 years, probably 10. I'm watching the COMEX inventory data, I'm watching industrial demand trends, and I'm watching premium levels as a real-time indicator of physical tightness. If premiums start expanding beyond 15% toward 20%, that's a strong signal to me that the supply situation is getting critical and I might accelerate my buying. If premiums somehow compress back toward 10%, I'll view that as an opportunity to add more aggressively. But I'm not waiting for perfect conditions, because perfect conditions might never come. The key insight I want to leave you with is this. The silver market is undergoing a fundamental shift from a market where paper and physical tracked each other closely to a market where physical scarcity is being priced independently of paper trading. These 15% premiums are not noise. They're not temporary. They're a structural feature of a market where supply is constrained, demand is strong, and the connection between paper price discovery and physical availability is breaking down. If you understand that shift, you understand why buying at these premiums makes sense for long-term holders. If you're still thinking in terms of spot price plus a small friction cost, you're operating with an outdated mental model and you're going to miss what's actually happening. The dealers running out of supply, the extended lead times, the mint rationing, the widening bid-ask spreads, these are all pieces of the same story. Physical silver is becoming scarce relative to demand, and the market is adjusting to that reality through higher premiums. So here's your action plan. If you own silver, assess your position, make sure you're properly allocated and properly stored, and decide if you want to add at these levels. If you're new to silver, educate yourself on the basics, start small, and build a position through dollar cost averaging. If you're watching from the sidelines, recognize that these premium levels are a signal, not a barrier, and make a decision about whether you want exposure to physical silver as part of your wealth preservation strategy. Things are moving in this market, not in spot price necessarily, but in the underlying physical fundamentals, and the people who are paying attention to premiums, to availability, to delivery times, those are the people who are going to be positioned correctly when the gap between paper and physical becomes undeniable to everyone. I track this daily, and if the data changes, my view can change. But right now, everything I'm seeing says the physical silver market is tightening, and these premiums are the canary in the coal mine telling you to pay attention. If you found this valuable, drop a comment below with where you are in your silver journey. Are you stacked and holding? Are you adding at these premium levels? Are you waiting for better entry points? I'm curious where the community is positioned, and if you have questions about premiums, about product selection, about dealers, drop those in the comments, and I'll try to answer as many as I can. The AG family is here to help each other navigate this market, and the more we share information, the smarter we all get. Subscribe if you haven't, because I'm putting out updates as the data develops, and things are moving fast right now. Tomorrow, I'm breaking down the industrial demand side of the silver story, why solar panel production and EV manufacturing are creating a demand floor that didn't exist 10 years ago, and why that matters for long-term silver holders. Stay sharp, stay informed, and remember, owning physical silver isn't about getting rich quick, it's about preserving wealth through a period of currency uncertainty. And in that context, a 15% premium today is a small price to pay for the certainty of metal in hand when you need it. Talk soon.